Welcome back to Frequently Asked Questions. I'm Chris Passmore, your social media CPA. So, I work with several companies that plan to sell their business. And one question I get all the time is, what's the difference between an asset sale and a stock sale? So I want to talk about that today, specifically with the focus on the tax implications. So first, what's an asset sale? What's a stock sale when you decide to sell your business? Well, let's first start with a stock sale. You as an entrepreneur have started a business, and when you did so, you likely bought and purchased the stock of that company. So you likely have shares in a safe somewhere at your house. So when you sell that stock to a successor, he's actually buying that stock from you, and he's taking ownership of the legal entity, and that legal entity will continue under the new owner. So that's a stock sale. Almost like if you invest in any S&P 500 company, the stock just transfers from person one to person two. Now contrast that to an asset sale. That's where the assets of a company are sold to a new company. So instead of transferring the common shares from you to another person, the company sells its assets, often the liabilities go also, to a newly formed legal entity. And in that situation, the newly formed legal entity takes over the business and the customers and the clients that you have. In a situation with an asset sale, though, your legal entity still remains. It still might be a shell, and you might eventually discontinue the company, but it still exists. And to highlight some of the pros and cons, usually a seller will prefer a stock sale because of the favorable tax treatment, and oftentimes a buyer will prefer an asset transaction because, one, they get a step up in the basis of the assets, and two, they avoid any legacy liability. When you do not buy the stock of a company, you do not inherit any history or risk from prior product sales or services being provided. So often the buyer prefers an asset sale. So that's at a high level, the two different types of transactions. So let's now just focus on the tax treatment. So in a stock sale, the seller has the benefit of capital gains, which I'm sure you all know is often a favorable tax rate, depending on how long you've held the stock itself, how long the company's been around. Now you contrast that to an asset sale, and let's just say you're a C corporation. A C corporation has to pay tax on the income of its activities, which include the sale of those assets to the new owner. So you have round one of tax of the sale at the company level, and oftentimes that's at ordinary tax rates, which is higher than capital. And then the real kicker for a C corporation is ultimately you want that cash to go to the owners of the company, right? You didn't sell the assets of the company so the cash stays in the company. You want the benefit of that money for you. So the kicker here is then you have the second level of tax, which will happen when the C corporation takes the proceeds from the transaction and then dividends that out to the owners. So it is a much, much higher tax rate for the owner of the C corp when that happens. Well, I hope you found that information useful. Is at a 30,000 foot level. There's a lot here to unpack. If you'd like to talk more about your business and a potential exit, please reach out to me on my website. That's socialmediacpa.com.